This video segment discusses mergers and acquisitions in the context of strategic management. Merger and acquisition activity is extremely important in strategic management as we continue to see larger and larger deals in front of us. One of the more recent in the acquisition area is that of Google's proposed acquisition of the Motorola cell phone business for $12.5 billion. This signals Google's desire to further diversify away from its search engine business into an area it thinks has great potential for profits. It's instructive to differentiate between merger and acquisitions because they are quite different. In a merger, what you'll have is two firms of somewhat similar size that just combine their assets, and their names typically become combined as well. You may recall the failed merger some dozen years ago between Daimler and Chrysler. Their names became merged. Acquisitions are quite different. This is a situation where you find a larger or more cash-rich firm buying a smaller organization. The smaller organization then comes the subsidiary of the larger organization. If the Motorola acquisition goes through, Motorola will become a subsidiary of Google. In the not too distant past, Kraft paid $20 billion to purchase Cadbury. Kraft is a United States convenience food manufacturer, and Cadbury is a confectioner into chocolates and chewing gum, and they are located in the United Kingdom. Kraft paid almost $20 billion to purchase all the assets of Cadbury. In the business press, we quite often see merger and acquisition activity discussed interchangeably, but these terms mean something very different, as you can see from this and from this slide as well. In the situation of mergers, you have a situation where either the names become combined or one of the parents may become the dominant player, and they're simply named after the larger or the more dominant organization which comes through in a merger. One of the parents, regardless of how their name changes or does not change, usually emerges as the dominant management team. I don't know what the case in Sirius XM radio is, but I do know that Daimler, a German company, became the dominant management team of Daimler Chrysler some years ago. In acquisitions, you have a situation where the acquirer, which was Kraft Foods in this case of Cadbury, just buys out all the firm's stock. So they bought all of Cadbury stock for nearly $20 billion. And these types of activities can be either friendly or hostile for the acquiree. There are several types of merger and acquisition activity, and I'm going to detail 5. Vertical activity in mergers and acquisitions could be simply to buy a supplier or customer. So they're vertically going forward or backward to streamline their cost structure. And Johnson & Johnson acquired some time ago Mentor, which is a latex glove company, among other things, to complement its products to become a supplier to other divisions of Johnson & Johnson, hence streamlining its cost structure. In the case of horizontal merger and acquisition activity, we see a situation where you merge or acquire a competitor, and we've seen that in the recent past in so much as that the Dutch firm InBev bought out Anheuser-Busch, thus reducing their competition to some extent. Product extension is a situation where you're buying complementary products or acquiring them to fit your portfolio, and in this case Kraft's acquisition of Cadbury is a perfect example of complementary products. It also exemplifies market extension, which is where you want to go into different markets. If you studied the Cadbury Kraft acquisition, probably the main reason that Kraft wanted Cadbury so badly is that Cadbury does very, very well in some emerging markets where Kraft does not do very well. And namely, those two markets are India and Brazil. Cadbury does very, very well there. Kraft has had minimal success and hopes to piggyback off Cadbury's leverage in those two large emerging economies for Kraft to do well. And that's market extension. And then there's also this unrelated firm of merger and acquisition activity. We call it conglomerate merger and acquisition activity. And this is a constant strategy that General Electric undergoes. General Electric, if you look at their their web page or their annual report, they are into a wide host of products, from light bulbs to appliances to jet engines to medical imaging products in the healthcare industry, and many more industries as well. So it buys firms that are quite different, but at the same time it diversifies their total risk by being involved in a lot of different industries. The logic behind this: related merger and acquisition activity. When you buy something that's related or you merge two firms that are related, what you hope is that you have value creation, and that is what's hoped from the merger between Sirius and XM. They need to create value because both firms were losing money, and we examine this when talking about the value chain. Part of that value creation is going to come from cost reductions, hopefully through economies of scale, or a larger new satellite radio organization being the new merged company. And also another value creating activity we see called economies of scope, and that is situations where firms can share competencies. And really this goes back to the value chain as well. They can share branding, name, content, subscribers, etc. There are some implementation issues in mergers and acquisition activity. No better illustrated than in the case of Daimler and Chrysler. And that's in cultural differences. A German organization merging with a US organization. Merger and acquisition activity always requires the merging of two different cultures, whether they be from two different countries or from the same country. You're still going to have two different and often quite disparate organizational cultures. That was a big problem for Daimler and Chrysler. Cultural merging involves a number of things. Among other things, it involves the combination of elements of two different cultures: management styles, products, customers, etc. It's interesting to see what's going to happen if the Google acquisition of Motorola happens and the Kraft acquisition of Cadbury, as of this speaking, of late 2011, is already complete, and we still have not seen yet the full effect of the combination of both cultures. We do know in the case of Kraft that Cadbury has fought this over in the United Kingdom because they're not happy about an American company buying out their company, and many are unsure about their stability as an organization going forward, thinking Kraft might take the chocolate company and move it back to the United States. So it's difficult, costly, and it's not always possible to pull off a merger and acquisition from the implementation side. One last thing I'll say is that merger and acquisition activity is kind of risky, but it's especially risky in the international side. Research shows that 70% of all mergers or acquisitions that take place between firms from different countries are going to fail. So if you think about that, your odds of making a merger or acquisition work when you have headquarters from two separate countries, your odds are not very good.